Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you for watching the channel. This week, we're going to review Monster Beverage Corporation. Now, we are a cash-flow-based rational investing channel that seeks to find out how much pure cash money a stock makes. Let's take a look at Monster Beverage. They just acquired a new business that enters them into the alcohol business. They've been growing crazy with their energy drink business. Let's figure out how much cash money these guys make, and if we buy it today and held it for a decade, how much return do we think we make on our investment? Ready? Let's get to work. Now on this channel, we review stocks with 5 key attributes. And what we're going to do is we're going to review Monster Beverage. We're going to look at the 5 key attributes that we use on this channel as a framework to begin to understand a business. Number 1, top line revenue growth. We want to see revenue must be growing. Number 2, earnings. Enterprise level earnings must be growing. Number 3, strong free cash flow. Number 4, low debt. We want to see a company with less than 3 times debt to EBITDA. And number 5 is a well-priced stock. Now, what is a well-priced stock? A well-priced stock is a stock with a conservative growth forecast that if you bought it today, held it for a decade, would beat the stock market. That's what we're looking to do. The S&P 500 on any 10-year basis would return 10%. We want to beat that on a risk-adjusted basis over that decade. Let's figure out how much cash money Monster Beverage makes and move forward. Well, the first thing we should do is we're going to review Monster Beverage's annual 10K. Now, I encourage everyone to read the annual reports. This is as of December 2021. We're coming up on December 2022, so that you won't get the new annual report for a couple months after into the new year. So let's review the old work, and then we'll forecast this business and figure out what they do. So the first thing is a review of Monster Beverage Corporation. The first page of the 10K gives them an overview of the business, right? They are a beverage company. Here are their listing of holdings, one of the major brands, right? Obviously Monster Energy Drink, but they also own Full Throttle and a couple other brands that you might recognize. Monster Beverage Company is known for their energy drinks, Monster Beverage and Full Throttle. Here, February 17, 2022, they just acquired an alcohol brewery company. It's going to enter them into the brewing business and the hard seltzer business, which I think is very interesting if they can execute as they have in their past with the energy drinks into this more competitive world of beers and hard seltzers. I also want to note that they did pay cash for the business, $330 million in cash, which is, I like to see. That means they're protecting their equity. They don't want to give equity because the equity for them is very valuable. They'd much rather give the cash and preserve the equity for themselves. Good move for Monster. All right, the next thing I want to do is just check the financial statements of Monster Beverage. Behind me is their balance sheet for the fiscal year in 2021. You can see cash and cash equivalents, $1.3 billion. This line here, short-term investments, is what we pull for excess cash. That's a cool $1.75 billion of jack sitting there that's outside of the checking account because they've piled up so much. Kudos to them. Good job, guys. Current assets, $4.6 billion. Some long-term investments, most of it seems to be goodwill and intangibles, about $2 billion. But overall, the $2 billion against the nearly $8 billion assets isn't too big, and they're getting that goodwill probably from paying a little bit above book value for some of the acquisitions they're making. But still nothing to be worried about. Current liabilities seem in place. So only $960,000 of current liabilities, whereas they had almost $4.6 billion of current assets. So a lot more current assets and liabilities. Love to see that. And also in long-term debt, there is no long-term debt. So they have a phenomenal financial position. They're completely unlevered, tons of cash, and very, very little liabilities. So everything is at the equity level, and the equity balance is growing for the business, which is what we want to see. Now, the income statement is very simple. They only have a few lines here. Net sales, $5.5 billion in 2021, up from 4.5, and up from 4.2 billion over the last 3 years. Nice growth. Decent gross margins, and the gross margins are growing, 2.5, 2.7, and 3.1 billion. Again, gross profit is the profit after the manufacturing cost of their energy drinks. Operating expense, I'd love to see them break this out a bit. They don't. That includes all their corporate costs, advertising, legal, marketing, rent for the main facilities, all the fixed cost, if you will. 1.3 billion, slight growth here over time, but not nearly as much growth as they're getting from the operating profit or the gross profit, which is providing them scale. And we really want to see that. That is true scale where they're able to keep this relatively flat and add $500 million onto the gross profit line. Great job, team. So just quickly rounding out the income statement, you've got profit before income tax, taxes, net income. You've got your fully diluted shares. I'll point out that it's decreasing, 546 million versus 555 million. It's dropping. And the earnings per share are growing up in the last 3 years from $2.03 per share to $2.57 per share. Hey, sorry to interrupt. If you like the content, please subscribe. I greatly appreciate it. Also, if you want more stock tips, check my website out, CASHFLOWinvestingPro.com, where I produce one-pagers like this one summarizing 10 years of financial information for American Express. I give you a forecast of what I think it's going to do, and currently, I think it's yield 23% IRR for the next decade. An amazing stock pick. There's lots more. Check out the link below for a free one-pager at CASHFLOWinvestingPro.com. The next thing we want to check is the cash flow statement, right? The most important statement. This is where the rubber meets the road, the true cash money that the business makes. There are 3 sections to the cash flow statement. The operating cash flow, how much they make from operating, the investing, what they invested in, and the financing, how they paid for it. So the first thing we want to do is operating cash flow right here, 1.15, call it $1.2 billion of operating cash flow. That's down a little bit from the previous year, and it's up slightly from the prior year. So kind of flat, kind of growing, kind of flat over the last 3 years. It looks like actually most of it is this receivable and inventory buy, these large negative numbers. That's $500 million right there that is bringing this number down. You might want to consider adding this back or zeroing it out, right? So if you zeroed this out and held receivables constant, you said you got all that cash from the revenue that you made, or the inventory, that you did not have to put $177 billion back into inventory, right? That's because they sold through their inventory, they replenished it. It doesn't happen every single year, so you could zero this out for just a guess, an idea of what they could have made, but for these working capital changes. That's what this section here is called. It's generally the working capital. But if I put 500 billion back in this number, I'm 1.6. It's definitely growing historically. The reason it's not being reported down here is there are some kind of one-time-ish numbers that they have to reinvest in their business as they're growing, post-COVID sales. It's happened to a lot of businesses in the 2021 year where they sold through their inventory during the pandemic, and now it's time to replenish. That should be a one-time blip here for the inventory. We should see next year it be either a smaller negative number or maybe even a slightly positive number. All right, so now they made $1.15 billion of jack last year by selling energy drinks. Okay, what do they do with it? Well, they made some acquisitions, but we're going to put those aside because those are one time and they're hard to anticipate. What we do want to pick up is purchase of property, plant, and equipment right there, $43 million. That's peeling money back off to put back in the factories. After that, what they do with it's the financing section. Well, they didn't really borrow any debt. That's fine. They didn't pay a dividend, and they purchased a little bit of common stock. They issued some common stock and purchased some common stock, but not all that much last year. The year prior, they actually bought a lot of stock. Purchase of common stock, $600 million, $700 million the years previously. So they made $1.15 billion. They reinvested $45 million. The biggest thing they did last year was to make that big acquisition. So I'd expect that cash next year that they're going to get even more cash next year. What do they want to do with it? They might turn back on the stock purchase program. They might go out and make another acquisition. Let's string this all together, and let's figure out how much money this guy makes over the long term and what we think the future looks like. All right, we're going to review the financials for Monster Beverage over time. Before I do that, I do want to reminder, hit the subscribe button if you like the content, or check out the link down below. I teach a course on how to be a financial analyst, how to do this for yourself, and I give you this Excel model so you can do it on your own and teach you how to do it for every stock that you have in your portfolio. Definitely check it out. All right, let's take a look at the revenue, the hard jack. How much money does this company make in revenue? Well, 2013, they reported $2.25 billion of revenue. And that revenue, my friends, has grown 2.4, 2.7, 3, 3.3, 3.8, 4.2, 4.6, 5.5. And I bet you next year will be a new high for them. That's every single year this business revenue has increased. That is great. It definitely checks a box for us. We're looking for a long-term revenue growth of 10 years on average, but this is every single year it's growing, which is like an added benefit of kind of reliability, if you will. On average, it's a 12% annualized consolidated growth rate between the years. phenomenal. EBITDA, that's enterprise level earnings. We don't look at earnings per share on this channel because earnings per share can be manipulated by the number of shares outstanding. Big companies like McDonald's or others use debt in the market to go buy shares and buy back shares to shrink the number of shares outstanding so that if they have flat earnings, a flat earnings divided by a shrinking share count means earnings per share is going up. The street thinks they're growing. The share price rises. They think they win. What we care about is true underlying earnings. Forget share count for a second. I want a business whose revenue and earnings are growing. Then if the shares reduce, then my per share growth rate is even higher. But fundamentally, I need revenue and company earnings growing. EBITDA stands for earnings before interest, tax, depreciation, and amortization. It's a rough, very rough gauge of cash flow. And yes, Charlie Munger does not like it for a host of reasons because a lot of times this number is manipulated. They call it adjusted EBITDA, where they add back all kinds of stuff. I'm just trying to get a gauge of long-term average. What is this business going to do on an operating income level? That's what we're trying to look at. $600 million of EBITDA in 2013. And that has grown to 700, a billion, billion two, billion three, billion four, billion seven, billion eight, almost a billion nine. That's growing at 15%, which is a slight margin increase over time, which is nice to see. It's also positive every single year. They have made money every single year. And it's also growing in line with revenue, slight increase in margin. That checks the box for us. I like to see that. All right, let's take a look at enterprise value. Enterprise value is the entire value of the business. This one's going to be pretty easy. Debt, we covered. Debt is zero. That's phenomenal. In this day and age, not having any debt in the business is amazing. As interest rates go up, the cost of that debt is getting higher. Spreads are widening in the market as the market tightens up, and debt that's repricing is having to reprice a whole lot higher, and earnings are adjusting downward. A business that has no debt doesn't have that risk. Great job. Cash, excess cash. Remember I pointed out the $1.75 billion of just pure jack sitting outside the checking account because they have so much they don't know what to do with it. I'm being facetious here. They obviously know what to do with it. They're making acquisitions, but it's not in the checking account. And I want to make sure we include that as excess cash, and that amount is growing over time. I like to see that. Market cap is shares outstanding times price. I use weighted average fully diluted shares. You want fully diluted, by the way, not just shares outstanding. Fully diluted for companies like Tesla and others that have convertible notes, convertible debentures, convertible bonds. That's debt that converts into equity, and it's dilutive. The fully diluted shares assumes all debt is converted, all warrants are issued, all options are taken to give you a fully diluted number, and it's what you want to use when you're forecasting and looking at the business. That's $12 billion of market cap, has grown to $55 billion. That's quite a growth rate, 20% on average over this period of time. If I add the debt plus the market cap less the cash, I get enterprise value. In this case, because debt is almost zero, it's basically market cap less excess cash, and I get enterprise value. Now, there's two more metrics we want to cover. Enterprise, we want a leverage ratio. Leverage is zero in this case, so that checks the box nicely. That normally we'll want less than 3 times. Here it's zero, awesome. And then enterprise value to EBITDA, our relative gauge of value. Now, we said enterprise value is the entire value of the entire business, and we said EBITDA is an annual earnings estimate for the business. Again, EBITDA is not an accounting a GAAP measure. It's an approximate number for kind of cash flow. And a lot of companies report EBITDA when they make acquisitions. A lot of investment banks and private equity groups talk about EBITDA, and that's why we want to use it, even though it's not a perfect number. We will get to cash flow in a second. What I'm trying to do here is look at the relative value of enterprise value relative to earnings. How many years do they have to make their earnings to pay for the business? Or how many years do I have to wait to get the money back, so to speak? And it looks like because this business is growing at 15, 20% a year annually, it's being given a premium, a nice premium. Not anything outlandish like a 50x, like a Salesforce, but a nice premium of roughly 24 times on average, as low as 19.6, as high as 28, 29. So that gives me a range of where it trades over the last decade. So if I can buy it On the low end of this range, I get a little bit of protection, a little bit of cushion, if you will. That's what we want to see. We want to see a company that's growing and you buy it at a reasonable level. All right, now let's take a look at free cash flow. All right, cash flow, the rubber meets the road. My favorite statement, your favorite statement, the cash flow statement. I encourage you to check down below for my investor course where I teach you how to do this yourself. You should be doing this for every single stock that you own in your portfolio. That's going to limit, yes, because it's a lot of work, it's going to limit the number of stocks you can hold. It's going to focus your funds onto your best ideas, and it's going to cause you to hopefully wait longer on your holdings, because we do not want to turn our portfolio. You buy a stock, you're going to hold it 5, 10, 25, 35 years. I don't know if anyone out here has read the book 100 to 1. It's a historical look at stocks that went up 100 times from their purchase price, and almost all of those stocks you have had to held the stock for 25, 30, 40 years to get that number. But it does happen, but you have to hang on, and most people can't or don't. So here we go. Cash flow from operations, CFO cash flow from operations, 2013, $342 million, has grown almost every single year to 1.16 million, which we discussed is probably actually a little higher, but for that inventory adjustment. And what I want to see is this 16% annualized growth rate over a period of almost 9 years is very similar to the EBITDA growth. That means that accounting team is expensing cash costs correctly. Good job, accounting team. Thank you very much. CapEx is how much money do they put back in the business. So they made $1.15 billion of jack. It's just sitting in a table. Hopefully they're Scrooge McDucking it. I would if I had that kind of cash. They're going to peel off $44 million, which is nothing for them. And then what that leaves them is $1.1 billion of jack. They have no debt. It goes right through to the equity owners. This is why there's such a premium on the stock, is it produces cash with high margins, it's growing, has no debt. And the CapEx required to maintain this cash flow is very small. It's less than 10% of the cash they generate, they put back. That means all the cash is available for stock buybacks, acquisitions, or dividends if they paid one. Here we go. Let's go to cash flow. So free cash flow to equity. This is what the business is truly, truly valued on. If I look at shares outstanding, they're roughly flat, kind of up and down, depending on maybe some acquisitions that they made here, but roughly they're coming back down, kind of flat over this period of time. If I divide free cash flow to equity, divide by shares, I get per share. They're about call it 250 if you add the $500 million in here. You're probably up to 250 a share. Divide by share price, I get a yield. Yield on average is 2.6%. That kind of yield is a growth yield, right? We look for cash flow yields in this channel at about 8, 9, 10%. We'd love to see that this company trades at a high premium. High premium, right? It's not single digits, it's high premium. 20%, 20 times earnings, 28 times earnings is a premium. High multiples mean low yields. So that's your trade-off. You're trading current cash flow for future cash flow. They expect this thing to grow and to continue to grow at the double-digit rates that it has been growing at. Okay, let's forecast, figure out where we go from here. All right, forecasting. EBITDA, $2 billion, just north of $2 billion, growing 12% year over year. This is my forecast. I kind of looked at the recent Qs that they had and put a guess out there. It's just a swag. What we really focus on is the long-term growth rate, which I'm bringing down over time to 10%. I think that might be a little high. It's still double digits every single year for another decade. That's a good assumption. On the market multiple, I gave it a 24 times. That is, again, is still fairly high. That's the average that we've experienced over the last decade, but it has been low as 18 times. I take my EBITDA of $5.2 billion out long term. I multiply by 24 times. I get an enterprise value of $126 billion. They have no cash, less the cash. They have no debt, less the cash. I get a market cap of $127 billion. Divide by shares outstanding, and I get a price target of $238.93. I will tell you right now, if I were to do this as a steel price, lower the market multiple, my forecast is $178, which is a monster haircut, right? That's $50 on, that's almost a 20%, 25% haircut on the price, simply because I change this market multiple. And what determines this multiple is popularity. This multiple is the mob of the market. All this other stuff can happen, and the stock can become unpopular, or maybe bonds are yielding 8% and you can make 8% risk-free with the US Treasury. So why would you put your money in the stock market and risk the up and down? There's lots of retirees, pension funds, life insurance companies that would make that trade. With that happening, the cash comes out of the stock market, multiples come down because it's no longer popular. You have less people bidding for a stock. Prices come down, multiples come down. So it's entirely reasonable that this number can approach 20 bucks and my long-term price target to fall to say less than $200. But I digress, let's continue. Free cash flow. Now we talked about free cash flow earlier, right? I've got just shy of just over $2.30. I'm picking up off the lower cash number that I had last year, growing at 12%, putting aside the adjustments for inventory, aside from the adjustments of AR, I want to just use their base number to give myself a little bit of cushion because this growth number is still double digit for a long time. That produces $5.83 of long-term free cash flow per share. I maintain the same yield, which is a low yield, and I get $222 per share out long-term, out 10 years for Monster Beverage. Okay, where does this stack up? Where's the rubber meet the road? So here we go. Let's take a look at the two price multiples that we have, the two price estimates. I've got a free cash flow estimate, $222 per share, and I've got an EBITDA market multiple method of $238 a share. I average them for 230 bucks. That's what I think out long term this stock might be worth. Okay, now is the time we look in the stock market and see what we can buy it for. You don't look before you do the numbers. You read the 10Ks, you build a forecast, you figure out how much you think the stock is truly worth, then you look to see what it's selling for. Otherwise, you will give more value to the price in the market and it will corrupt your thinking. The reality is this price is a bidding war every single day and it changes for all kinds of different reasons, none of which might have anything to do with the cash flow of the business. So you want to form an opinion on the stock, then look. What this means is that $96 a share, current enterprise value is just shy of $50 billion. Forward EBITDA is $2 billion, so it's trading now at 24 times, which is on the high end of its range. And it is about exactly where we said the exit multiple would be. So there's no market multiple expansion here. You're just relying purely that this number stays there. 24 times because I'm using 24 times on my exit. So there's no market multiple expansion. You're just saying, hey, I keep the market the same and just grow earnings. What does that do for me? Well, here we go. My cash flow per share, I'm in at 96. I'm out at 230, the higher number that we were discussing. This stream of cash flow produces a 13% IRR over the decade. Which is a market-beating return. I think this price is a very interesting price because it does truly beat the return, but there's risk involved in the price that I'm displaying. First risk, this growth rate. We are currently going into a slowdown of the economy. Interest rates are rising. I don't know if the consumer retailer is going to continue to buy the alcoholic beverage, the hard ciders, the Monster energy drinks like they have in the same quantity that they have before. So that could come down. We have inflation. Raw material costs for the aluminum cans could go up and hurt margins. Labor costs could go up and hurt margins. I think assuming this growth rate at double digit over this time frame might be a little aggressive. Number two, I think this long-term exit, I would like to see that at 18 times or 20 times. What happens if I put this at 20 times? And I said, let's rely on all just EBITDA method for a second. What does this do to my return? My return falls to 12%. So it's okay, still beating, not bad, but that's not enough for me. I need a little bit more cushion than that, especially going into a market as dynamic as we currently are. Let me just put all this stuff back. I think this is 24.3. 24.3. So I think we need a little bit more cushion here. Let's put it on a spectrum. If I said, hey, I'm at $96 per share right now at 13%, If it drops $10 and I get 15% or higher, it starts getting attractive to me. I want a 50% cushion for me for the S&P 500, if not a little higher. I think in this market, there are so many stocks selling for very, very cheap that 15% is kind of the entry point, especially if inflation is 8%, because you're basically just doubling inflation here at that rate. You're not getting as big a return as you think you are because inflation is still high. So I'd want to see this price come down, give myself a little cushion, be on that outlier chance that no, you got to steal when you buy the stock. So for this reason, I think what we're going to do right now, let's recap the 5 key factors. Number 1, top line revenue growth. Yes, it's absolutely growing. Number 2, earnings. Earnings are growing. Strong free cash flow. Absolutely a strong free cash flow. Number 4, low debt. Debt is 0. Number 5, well priced. Not enough. Technically, what I said is that it needs to beat the S&P 500, which is 10% on average for 10 years. That looks like we've checked the box. But I think on a risk-adjusted basis, given the market, what I said, the double-digit growth, I'm going to give it a meh. Wonderful company. I love the company. Love what they're doing. Love the cash flow. Love the assets. Love the no debt. I love everything about it. But I think the price is just a smidge too high, and I would like to see that price come down. If it does, fantastic. I like the stock. So I want to throw me a comment down below. Don't forget to hit the subscribe button if you like the content. Really do appreciate that. If you want to learn how to do this, I suggest you go to my website, CASHFLOWinvestingpro.com. I teach a course. It's 3 hours of content. I give you this Excel model. We walk through Apple. I teach you how to find revenue, EBITDA, what is diluted shares, how to correct for reverse splits of stocks or splits of stocks, how to calculate debt, what do you do with capital leases, what do you do with current payment of debt, what that number is, what are market multiples, what are yields, how to create a forecast, and ultimately how to risk adjust a portfolio so you have a focused number of stocks that you can tangibly review every year and hopefully grow your net worth where you want to go. That's what I try to teach. It's what I do as a professional, as a CFO for companies in the U.S. That's my primary job. I do this YouTube channel just to help educate people on finance. I think that there's not nearly enough education on finance out there in the world, so this is just my attempt to try to throw some knowledge out there. But check the course out. Also, if you like the course, but you don't have time to do that work, I have a Cash Flow Club. Cash Flow Club produces one-pagers. A one-pager is a simple one-page summary of exactly what I just went over through here in an hour. We and the analyst team are kicking out 10 to 15 one-pagers every single month of stocks that are yielding estimated to return as high as 20-25% annually over the next 10 years based on the models that we just walked through. So on a one-pager, you get 10 years of information, just like I went through. You get a forecast for EBITDA, a forecast for free cash flow. You get a market summary where we write up our thinking, our thoughts on a company, and you get the 5 key attributes summarized for you. We're kicking these out, and we even hosted a webinar with all the members where I went through all the stocks that we're currently reviewing, and I showed the top picks of some stocks that are estimated, like I said, to produce 25-30% return. Now, nobody knows what the future holds. I don't, you don't, nobody knows. What we're trying to do is we're trying to make a conservative forecast with a company that has low debt, it is growing, and you can buy it at a reasonable price. And if we can check those boxes, hopefully that means the odds are that we will get a better than market return. That's the objective. Nobody knows what's going to happen in the future, but we try to frame it so the probability of success is greater than loss. That's what we try to do at the Cash Flow Club. I encourage you to join. In the description down below, you can get a free one-pager by going to my website, CASHFLOW Investing Pro. And any member that joins gets access to the former webinar that we just went through. I'll be doing those quarterly with all the members of the club, so definitely check it out. This is Cameron Stewart. This is Rational Investing. I appreciate all the comments. Thank you very much. Let me know what stock you want to see next. I'm happy to take recommendations. There are absolutely a ton of stocks out there. If you put aside the tech bubble for a moment and you go hunting through to find out what's truly making cash, there are a lot of stocks out there that are making cash, and we're covering them in the Cash Flow Club. I highly recommend you check it out. for a year. I know that's a lot, a year. Why? Because you need perspective. One of the things that people miss is they miss seeing a variety of stocks over a long period of time. They see one stock they like, they buy it. But if you hang out and you look at stock after stock after stock after stock after stock for a year, you will get a perspective on what is possible. What is a good quality stock? What is a bad stock? Why? That perspective for you is worth a lot over time by picking the right stock. So please jump in, stick, give it a ride, see what you think. We're building, we're expanding the team all the time. Okay, that's enough of the pitch. Thanks for sticking around. I really appreciate it. And throw me a comment down below. Take it easy. Bye-bye.